OG John AG here. Around 1 hour ago from when I'm recording this, the financial markets just experienced what can only be described as a complete structural breakdown. Gold crashed 8% in 60 minutes. Silver down 12%, combined 5.9 trillion in precious metals. Market capitalization vanished in 30 minutes. 30 minutes. To put that in perspective, that's the combined GDP of the UK and France evaporating in less time than it takes to order pizza. And here's what makes this absolutely insane. This wasn't just metals. Bitcoin dropped $2,700, liquidating 356 million in longs in the same hour. Nearly 100 billion wiped from crypto. The S&P lost over 500 billion in market cap today. Nasdaq down 2.5%, plus 760 billion gone. Before we dive in, I'm active on X. Many of you are already there watching real-time updates, technicals, vault flows, data that doesn't make it to YouTube. I'm just warming up. Advanced tools are coming soon to that platform. So, if you're not plugged in yet, now's the time. The handle is the same on both. OG John AG. Can't be duplicated, can't be changed. Yes, I know there are fake accounts. Ignore them. Same handle. Both platforms. Simple. I've made it easy for you. I can't take down every fake account out there, but OG John AG is the one thing they can't copy. It's mine. I earned it. For the new people, I don't sell signals, mentorships, courses, nothing. I don't beg for subscribers. We break down the full picture here. No fear, no greed, just independent thinking. A lot of you tell me this helps. I'm learning from your questions too. Drop any question in the comments or just type OG John AG so I know you're here listening, getting value. My team uses that as feedback. Now, before we go further, let me be crystal clear about what we're looking at. This move is off the charts historically. We're not talking about normal market volatility. We're talking about a system break. The mechanics of the market just failed under extreme stress. Let's start with silver, because this is where the story gets genuinely bizarre. Silver just tapped the 150-hour exponential moving average and hit 30 RSI. That's oversold territory on the hourly. And here's the kicker. The flash crash bounced exactly off that 150-hour moving average. Not close to it, exactly off it. That's the third time in recent weeks we've seen that level hold as critical support. Above the 150-hour EMA, massively bullish and completely unbothered. Above the 2-month uptrend, very bullish. Below that uptrend, large pullback risk kicks in. Long-term still bullish, but it starts being scary. The primary uptrend line sits down around $91. We haven't breached the 150-hour. We held it on a move that just vaporized 5.9 trillion in precious metals wealth. Now, connect the dots to what's happening on the physical side. The Shanghai silver premium is plus $25. 25. That means physical buyers in China are willing to pay $25 over spot to get their hands on actual metal. While paper prices are cratering, physical premiums are exploding. Does that sound like a market in equilibrium to you? And it gets better. 246 silver delivery notices issued Wednesday. Total January silver deliveries have now risen to 9,154 contracts. That's 49.27 million ounces. The scramble for silver continues. So let me get this straight. COMEX delivery demand is surging. Shanghai premiums are plus $25. And the paper price just crashed 12% in under an hour. Let that sink in for a second. This is the disconnect between physical reality and paper pricing laid bare for everyone to see. When safe haven assets, gold and silver, the assets people are supposed to run to when everything else is falling apart. When those assets vaporize trillions in minutes, that's not a sign of weakness in the metals themselves. That's a sign of something fundamentally broken in how they're being priced. The physical demand is screaming one direction. The paper price is collapsing in the other. Make it make sense. So, what actually triggered this carnage? The crypto space gives us a clue. During the crash, we saw coordinated massive dumps. Binance offloaded 40,467 Bitcoin. Wintermute 12,697, Coinbase 15,630, entities linked to Trump insiders 15,189, Kraken 5548, OKX 7966. Now, whether this was planned manipulation or just panic contagion, the outcome is identical. Massive instantaneous deleveraging that ripped across Bitcoin equities and precious metals simultaneously. This wasn't gradual price discovery, this was forced liquidation at scale. And that brings us to the real question today, as markets were in full panic mode. Is this a foretaste of an impending Gulf War? If war really does break out, what do you think will be the first thing to turn green again? Now, I'm not going to sit here and tell you war is definitely coming, or that this crash was definitely caused by geopolitical tensions. I don't know that. Nobody does yet. But what I do know is that when you see coordinated selling across Bitcoin stocks and precious metals, when you see extreme events like this, internal strains in the system's mechanics, cascading margin calls, collateral evaporation, forced selling, you're looking at a fragile system under massive stress. Here's the mid-video reveal that reframes everything we just discussed. I posted this myself earlier today. Gold down 8%, 3 trillion erased. Silver down 12%, 760 billion erased. S&P 500 down 1.2%, 780 billion erased. Nasdaq down 2.5% plus 760 billion erased. Trillions vaporized in an hour. Notice something. The percentage move in precious metals was 4 to 10 times larger than the percentage move in equities. But the dollar amounts erased were roughly comparable. 760 to 780 billion for each major index in silver. Gold lost 3 trillion because the market cap is larger. What does that tell you? It tells you the leverage and positioning in precious metals was absolutely enormous. When the margin calls hit, when the collateral disappeared, metals got hit harder on a percentage basis because the paper leverage was more extreme. That's not a sign of weak fundamentals. That's a sign of how disconnected paper pricing has become from physical reality. When Shanghai is paying $25 over spot and COMEX deliveries are at 49.27 million ounces in January alone, you don't have a demand problem. You have a paper market problem. Now let's talk about what could go wrong here, because I'm not going to sit here and pretend this is all bullish all the time. The bearish case is real, and it's this. If that 150-hour EMA breaks, if we lose that technical support level, the next stop is the primary uptrend around $91. That's another 10% down from current levels. If broader equity markets continue to crash, if we see more forced liquidations, if the margin calls cascade further, precious metals could absolutely get dragged down further in the short term. Physical stackers might panic, weak hands might sell, the banks and big institutions might use this as an opportunity to accumulate at cheaper prices while retail freaks out. We could see more volatility in the coming days. The next few days will be insane. That's not hyperbole. This kind of move creates follow rough volatility, almost always. And here's the risk disclosure you need to hear. If you're trading this on leverage, if you're in paper positions, if you're using options or futures, you could get absolutely wrecked in this environment. Margin calls don't care about your thesis. Forced liquidations don't care about fundamentals. If you're over-leveraged, this kind of move can wipe you out before the market turns around. That's just reality. But here's the other side. Here's why the bearish case, while real in the short term, doesn't change the long-term structural setup. Every single bullish factor we've been tracking for months is still in place. In fact, it just got reinforced. COMEX deliveries surging, still happening. Shanghai premiums exploding, still happening. Industrial demand for solar, EVs, data centers, 5G, defense hasn't changed. Central bank gold buying hasn't changed. Dollar debasement from endless deficits hasn't changed. Geopolitical fragmentation with China hoarding and BRICS diversifying hasn't changed. What changed is the paper price got absolutely obliterated by forced selling and deleveraging. And you know what? That's happened before in every major bull market. Go look at 2008, go look at 2020 March. Precious metals got crushed in the initial panic as everyone scrambled for cash and margin calls hit. And then what happened? They ripped higher as the real implications of the crisis became clear and central banks flooded the system with liquidity. I'm not saying that's guaranteed to happen this time. I'm saying the pattern is there. The physical fundamentals are there. The technical support held at the 150-hour EMA for now. If it continues to hold, if we base here and bounce, this could be a massive shakeout before the next leg higher. But if it breaks, we need to be prepared for more pain before things get better. So, where does that leave us? Let me give you 3 key takeaways, and then we're out. Number 1, the paper-physical disconnect just got exposed in the most dramatic way possible. Shanghai plus $25 premiums and COMEX deliveries at 49 million ounces. While prices crater is the definition of a broken pricing mechanism, physical is telling you one story. Paper is telling you another. Which one do you trust? Number 2, this was not normal volatility. 5.9 trillion in precious metals market cap evaporating in 30 minutes is beyond 6 sigma. Multiple analysts called this a system break. Whether it's coordinated manipulation like the crypto dump suggest, or just cascading margin calls and collateral collapse, the result is the same: extreme fragility in the financial system. Number 3, The technical level to watch is that 150-hour EMA. It held. If it continues to hold, the bull market stays intact. If it breaks, we're looking at potential retest of 91 on the primary uptrend, and that gets scary fast. Trade accordingly, manage risk accordingly. I don't know if this was the start of something bigger geopolitically. I don't know if this was just a massive leverage flush. What I do know is that the next few days are going to be absolutely critical for determining whether this was a shakeout or the start of a larger correction. Stay sharp. Watch those technical levels. Watch the physical premiums. Watch COMEX inventories and deliveries. The truth will reveal itself in the data, not in the panic. Do your own due diligence. This is not investment advice. These are observations about what just happened and what it might mean. You are responsible for your own decisions and your own risk management. Nobody else. If you don't understand the risks, if you don't have a plan, if you're over-leveraged, this environment will eat you alive. But if you've been building physical, if you understand the long-term thesis, if you're positioned appropriately for volatility, then this might just be noise before the next major move. Time will tell. Stay focused, stay disciplined, invest with logic, not hype. OG out and